What if I told you that right now, at this very moment, we're witnessing the setup for one of the most explosive moves in silver's history? Not in a year, not in 6 months, but potentially in the next few weeks. And most investors have absolutely no idea it's coming. Let me paint you a picture of what's happening right now in the silver market. Because what I'm about to share with you isn't speculation. It's not hopium. It's cold, hard data that's been quietly building for 5 consecutive years, and we're now at the breaking point. Silver just hit record highs above $68 per ounce. That's a 132% increase in just 12 months. But here's what nobody's talking about. This isn't the top. This is just the beginning of what could be the most significant wealth transfer opportunity in precious metals we'll see in our lifetime. You see, there's something happening in the silver market that's never happened before. Not in the 1980s when silver hit $50. Not in 2011 when it rallied to 49. What's happening now is fundamentally different, and it's creating a perfect storm that could send silver into triple digits. For 5 consecutive years, the silver market has been in a structural supply deficit. Let me explain what that means in plain English. Every single year, the world has been consuming more silver than it produces, not by a little bit. We're talking about 820 million ounces of deficit accumulated over just 5 years. Think about that for a second. 820 million ounces. That's not coming back. That silver has been consumed, used up in industrial applications, gone forever. And the deficit isn't getting smaller. It's getting bigger. The Silver Institute just released their forecast, and even with a slight decline in overall demand, we're still looking at 1.12 billion ounces of demand against production that simply cannot keep up. But here's where it gets really interesting. That slight decline in demand, it's not coming from the sectors that matter most. Industrial demand for silver is exploding in ways that most people don't understand. And it's being driven by 3 massive technological revolutions happening simultaneously: artificial intelligence, electric vehicles, and solar energy. These aren't trends. These are fundamental shifts in how our entire civilization operates. Let's start with AI. Every single data center that powers artificial intelligence requires massive amounts of silver. We're not talking about a few ounces here and there. These facilities use silver in their electrical connections, their cooling systems, their power distribution networks. And here's the kicker. The AI revolution is just getting started. Companies are building data centers at a pace we've never seen before. Microsoft, Google, Amazon, they're all racing to build the infrastructure for AI. And every single one of these facilities is a silver-consuming machine. The Silver Institute forecasts that silver demand from the technology sector is going to grow at a compound annual rate of over 3% through the end of the decade. But AI is just one piece of the puzzle. Electric vehicles are consuming silver at rates that are shocking even industry experts. Every EV uses significantly more silver than a traditional combustion engine vehicle. We're talking about differences measured in ounces per vehicle, and the world isn't just adding a few EVs here and there. We're in the middle of a complete transformation of the global automotive industry. China is leading the charge. They're producing EVs at a scale that's hard to comprehend. Europe has mandated the phase-out of combustion engines. Even the United States, despite political headwinds, is seeing EV adoption accelerate. The Silver Institute projects automotive silver demand to increase at a compound annual growth rate of 3.4% between now and the end of the decade. And then there's solar. This is where things get really wild. Solar panels are absolutely dependent on silver. There's no substitute that works as well. Silver is the most conductive metal on Earth, and in solar applications that conductivity translates directly into efficiency. Every percentage point of efficiency matters when you're trying to capture energy from the sun. The solar industry consumed record amounts of silver last year, and that consumption is accelerating. Why? Because the world is in a race to build renewable energy infrastructure. China is building solar farms that are visible from space. Europe is covering every available rooftop. Even oil-rich Middle Eastern countries are investing billions in solar because they see where the future is headed. Here's what most analysts miss. These 3 sectors, AI, EVs, and solar, they're not competing with each other for silver. They're all growing simultaneously, and they're all accelerating at the same time. This creates a demand profile that the silver mining industry simply cannot match. Let me tell you about the supply side of this equation, because this is where the story gets even more compelling. Silver isn't like gold. You can't just decide to mine more silver when the price goes up. Why? Because most silver, about 70% of it, comes as a byproduct of mining other metals: copper, lead, zinc. Miners are digging for those metals, and silver just happens to come along for the ride. This means that silver supply is incredibly inelastic. Even with prices more than doubling, we're not seeing a massive surge in new silver production. The mines that produce copper aren't going to suddenly produce more copper just because silver prices are high. They're operating on completely different economics. And here's something that should terrify anyone who's short silver or sitting on the sidelines. The easy silver has already been mined. The high-grade deposits are largely depleted. New silver mines are deeper, lower grade, more expensive to operate. The all-in sustaining costs for silver miners have been climbing steadily, and that puts a floor under prices that's much higher than most people realize. But there's another factor at play that's absolutely critical to understanding where silver is headed: the paper silver market. Let me explain how this works because it's one of the most important dynamics in precious metals. On the COMEX, the major futures exchange for silver, there are massive amounts of paper contracts that represent silver. But here's the thing: most of that silver doesn't actually exist. It's paper promises. Traders buy and sell these contracts, and the vast majority of them never take physical delivery. They just settle in cash. For years, this paper market has been used to suppress silver prices. When physical demand would start pushing prices higher, large commercial traders would dump massive amounts of paper contracts onto the market, creating artificial supply that would cap the price. It's been one of the most effective price suppression mechanisms in any commodity market. But something is changing. The ratio of paper silver to physical silver has been shrinking. More and more traders are standing for delivery. They're saying, "I don't want your cash settlement. I want the actual metal." And when that happens, the exchanges have to scramble to find physical silver to deliver. Silver lease rates have hit levels we haven't seen in decades. When you hear about lease rates spiking, what that's telling you is that there's a shortage of physical metal available to borrow. Banks and institutions that need silver for various purposes are having to pay premium rates just to get their hands on it temporarily. This is creating enormous stress in the physical market. And here's why that matters. At some point, the paper market breaks. At some point, there are so many claims on physical silver that the system simply cannot deliver. When that happens, we're going to see a price discovery event unlike anything in modern commodity markets. Think about what happened with nickel on the London Metal Exchange a few years ago. Prices went absolutely parabolic in a matter of days because there was a massive short squeeze and not enough physical metal to deliver. The exchange had to halt trading. Contracts were canceled. It was chaos. Now imagine that happening in silver, but with even more leverage and even less physical metal available. The setup we're seeing right now has all the hallmarks of that kind of event. You've got 5 years of accumulated deficits. You've got industrial demand that's accelerating, not slowing down. You've got a paper market that's increasingly stressed. And you've got investors who are just starting to wake up to what's happening. Let me tell you about what the smart money is doing, because this is where the story gets really interesting. Central banks have been accumulating gold at record rates. Everyone knows that. But what most people don't know is that silver is starting to attract institutional attention in ways we haven't seen before. Large investment funds are looking at the supply-demand fundamentals and reaching the same conclusion. Silver is dramatically undervalued relative to its industrial importance and its scarcity. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. It's moved from over 100 to 1 down to around 70 to 1. Historically, that ratio has averaged somewhere between 50 and 60 to 1. If we just return to historical norms, silver has significant upside even if gold stays flat. But here's the thing: gold isn't staying flat. Gold is making new all-time highs. And when gold runs, silver typically runs harder and faster. There's a reason they call silver gold on steroids. It's more volatile, it's more explosive, and when the momentum shifts, it can move in ways that shock even experienced traders. We saw this in 2011 when silver went from $18 to $49 in a matter of months. We saw it in the 70s when silver went from $2 to $50. But those moves were driven primarily by investment demand and monetary concerns. What we're seeing now is different. This time we have investment demand plus industrial demand plus a structural supply deficit. It's a triple threat that creates a setup we've never seen before in silver's history. Now, let me talk about something that's relevant if you're thinking about your retirement security and wealth preservation, because what's happening in silver isn't just a trading opportunity. It's a fundamental shift in how we should think about protecting purchasing power. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It covers how to get physical precious metals into your retirement account without tax penalties, the custodians that specialize in this, and the mechanics of how it all works. It's in the description below. Worth checking out if that's relevant to your situation. Anyway, back to where this price is headed next, because the technical setup is just as compelling as the fundamentals. Silver just broke through major resistance levels that had held for years. When you look at the chart, you can see a massive cup and handle pattern forming. For those who don't follow technical analysis, that's one of the most bullish continuation patterns you can find. It suggests that the previous high wasn't the end of the move. It was just a pause before the next leg higher. The breakout we're seeing now is happening on massive volume. That's important because it tells you this isn't just a few speculators pushing the price around. This is real money, real conviction, real buying pressure, and it's coming from multiple sources simultaneously. Retail investors are starting to pay attention. You can see it in the premiums on physical silver coins and bars. Dealers are struggling to keep inventory. Delivery times are stretching out. When you call a major bullion dealer right now, they're quoting you 4 to 6 week delivery times on certain products. That's not normal. That's a sign of stress in the physical market. But it's not just retail. Industrial users are getting nervous. Companies that use silver in their manufacturing processes are starting to forward buy, locking in supply at current prices because they're worried about availability and price spikes down the road. This creates additional demand that compounds the supply deficit. And then you have the investment funds. ETFs that hold physical silver have been seeing inflows. Not massive yet, but steady. And here's what's important about ETF flows. They're a lagging indicator. By the time the big money shows up in ETFs, the move is usually well underway. We're still in the early stages of that institutional buying wave. Let me tell you a story that illustrates what can happen when silver really gets moving. Back in the late 70s, the Hunt brothers tried to corner the silver market. They accumulated massive positions, and silver went from around $2 an ounce to $50 an ounce in just a few years. Now, I'm not suggesting anyone should try to corner the market. That ended badly for the Hunts. But what that episode demonstrated was just how explosive silver can be when supply gets tight and demand surges. The difference between then and now is that we don't need anyone trying to corner the market. The fundamentals are doing it naturally. Industrial demand is cornering the market. The supply deficit is cornering the market. And unlike the Hunt brothers, industrial users can't just decide to sell when prices get high. They need the silver for their products. They have to buy it regardless of price. This creates a dynamic where price becomes almost irrelevant to a significant portion of demand. Solar panel manufacturers need silver. They're not going to stop making solar panels because silver hits $80 or $100. They'll pay whatever they have to pay because the alternative is shutting down their factories. Same with EV manufacturers. Same with electronics companies. Same with medical device makers. Silver is critical to their operations, and there's no substitute that works as well. This inelastic demand is what creates the potential for vertical price moves. Now let's talk about what could trigger the next major leg higher. Because while the fundamentals are building pressure, markets often need a catalyst to really explode. One potential catalyst is a major supply disruption. Silver mining is concentrated in a handful of countries: Mexico, Peru, China, Australia. If there's political instability, labor strikes, environmental issues, or natural disasters in any of these regions, it could take significant supply offline. And remember, because silver supply is inelastic, that lost production doesn't just get made up somewhere else. Another catalyst could be a major industrial buyer announcing a strategic stockpiling program. Imagine if Tesla, or one of the big Chinese EV makers, announced they were building a 6-month or 12-month inventory of silver to protect against supply disruptions. That kind of buying would send shockwaves through the market. Or consider what happens if one of the major silver ETFs has a delivery problem. If they can't source enough physical silver to meet redemptions or creations, it would expose the fragility of the paper market and could trigger a rush to physical metal. But here's the thing, we might not need a specific catalyst. Sometimes markets just reach a tipping point where the fundamentals are so overwhelming that price has to adjust. We might be at that point right now with silver. The 5-year deficit isn't going away. Industrial demand isn't slowing down. The paper market is increasingly stressed, and investors are starting to connect the dots. When you put all of that together, you get a market that's coiled like a spring, ready to explode higher. Let me give you some perspective on what vertical move could actually mean in terms of price targets, because I'm not just throwing around hyperbole here. There are serious analysts with serious methodologies projecting silver prices that would shock most people. If silver just returns to its inflation-adjusted high from 1980, we're talking about prices well over $150 per ounce. Now, I'm not saying that's going to happen tomorrow, but it gives you a sense of how undervalued silver is relative to its historical peaks when you adjust for inflation. If the gold-to-silver ratio returns to its historical average of 50 to 1, and gold stays where it is, silver would be trading around $50. But if gold continues higher, which many analysts expect, that ratio-based target moves higher too. If you look at silver's industrial importance and compare it to other critical industrial metals like copper or platinum, silver is trading at a significant discount on a relative basis. Copper has been making new highs. Platinum has been rallying. Silver is just starting to catch up to where it should be based on its industrial demand profile. And then there's the monetary angle. As central banks continue to debase currencies, as government debt levels spiral higher, as geopolitical tensions increase, precious metals become more attractive as stores of value. Gold gets most of the attention in that narrative, but silver is gold's little brother. When gold runs for monetary reasons, silver typically follows and often outperforms on a percentage basis. Some of the more aggressive analysts are talking about silver potentially reaching $200 or more in a true mania phase. Is that likely? I don't know. But is it possible given the supply-demand fundamentals and the historical precedent for silver's volatility? Absolutely. Here's what I do know. The risk-reward setup in silver right now is as compelling as I've seen in any commodity market. The downside is limited by rising production costs and industrial demand that provides a floor. The upside is potentially massive given the supply deficit and the explosive nature of silver when it really gets moving. Think about the psychology of markets for a moment. Right now, most investors aren't paying attention to silver. It's not making headlines every day. It's not the hot trade that everyone's talking about. But that's exactly when the best opportunities present themselves. By the time everyone knows about it, by the time it's on the cover of financial magazines, the easy money has already been made. We're in that sweet spot right now where the fundamentals are screaming that something big is coming, but the crowd hasn't caught on yet. The smart money is accumulating. The industrial users are getting nervous. The supply deficit is building, and the price is just starting to reflect the reality of the situation. I want to talk about what this means for different types of investors, because the opportunity in silver isn't one size fits all. If you're a trader, the volatility in silver creates opportunities for significant short-term gains, but you have to be prepared for the wild swings that come with that volatility. Silver can move 5 or 10% in a single day when it really gets going. If you're a long-term investor focused on wealth preservation, silver offers something unique. It's a tangible asset that can't be printed or created out of thin air. It has thousands of years of history as a store of value. And unlike gold, it has significant industrial demand that provides fundamental support for prices. If you're thinking about retirement and protecting your purchasing power over decades, having exposure to physical silver makes sense as part of a diversified strategy. Not all of your portfolio, but a meaningful allocation that can protect against currency debasement and provide upside if we see the kind of move that the fundamentals suggest is coming. The key is understanding that silver is different from stocks or bonds or real estate. It doesn't generate cash flow. It doesn't pay dividends. What it does is preserve purchasing power and provide optionality on a major price move driven by supply-demand fundamentals. Let me address something that skeptics often bring up. If silver is so great, why hasn't it moved more already? It's a fair question, and the answer tells you a lot about how commodity markets work. Markets can stay irrational longer than you can stay solvent, as the saying goes. Just because the fundamentals are bullish doesn't mean price immediately reflects that. It takes time for supply deficits to manifest in price. It takes time for industrial users to realize they have a problem. It takes time for investors to shift their attention and capital. But here's the thing about commodity markets. When they finally move, they move fast. You don't get a lot of warning. You don't get a gradual, orderly repricing. You get explosive moves that catch most people off guard. That's the nature of physical commodity markets, especially ones with inelastic supply like silver. We're seeing the early signs of that move starting now. The 5-year deficit is finally showing up in lease rates and physical premiums. Industrial users are finally starting to forward buy. Investors are finally starting to pay attention. The paper market is finally showing signs of stress. All of these things were building beneath the surface for years. Now they're starting to manifest in price. And if history is any guide, Once silver really gets moving, it moves faster and further than almost anyone expects. Think about what happened in 2020 during the COVID pandemic. Silver dropped to around $12 an ounce in the panic. Within months, it had nearly tripled to almost $30. That's the kind of explosive move silver is capable of. And that was without the structural supply deficit we have now. That was without the industrial demand growth we're seeing now. That was without the stress in the paper market we're seeing now. Imagine what happens when all of these factors align and silver really starts to run. We're not talking about a move from 12 to 30. We're potentially talking about a move from the high 60s to triple digits. The percentage gains could be even more dramatic than what we saw in 2020. And here's something that should really get your attention. We're still in the early stages of the industrial demand growth. The AI revolution is just beginning. The EV transition is just beginning. The solar build-out is just beginning. These are multi-decade trends that are going to consume increasing amounts of silver every single year. The supply deficit we have now, it's going to get worse before it gets better. There's no cavalry coming to save the day. There are no massive new silver deposits being developed that will flood the market with supply. The mines that exist are producing at capacity, and new mines take years to develop even if you find economically viable deposits. This is a supply-demand imbalance that's going to persist and likely intensify. And that creates a setup where price has to do the work of rationing supply. Price has to rise to the point where some marginal demand gets destroyed, or where recycling becomes more economical, or where substitution becomes viable in some applications. But here's the problem. In most of silver's critical industrial applications, there is no good substitute. You can't make solar panels as efficient without silver. You can't make electrical connections as reliable without silver. You can't make medical devices as effective without silver. The unique properties of silver make it irreplaceable in many applications. So price has to rise to a level where industrial users are willing to pay whatever it takes to secure supply. And that level could be significantly higher than where we are now. Some industrial analysts are privately talking about silver needing to trade at $100 or more to truly balance the market given current demand trajectories. Let me paint you a picture of what the next few months could look like if this thesis plays out. We're already seeing silver making new highs. As it breaks through psychological levels like $70, then $80, it's going to attract more attention. Financial media will start covering it. Retail investors will start piling in. FOMO will kick in. At the same time, industrial users who have been hoping prices would come back down will realize they're not coming down. They'll start panic buying to secure supply. This will create additional demand that compounds the supply deficit. ETFs will see massive inflows as institutional investors decide they need exposure. This will require the ETFs to buy physical silver, further tightening the physical market.